Every single day we see those flashing red and green numbers on our phones. Nifty, Sensex, arrows shooting up, arrows plunging down, and news anchors just completely panicking on TV. It causes so much anxiety, right? But what if I told you it's actually not that complicated? Welcome to This Explainer. Grab your coffee, relax, and chaliye shuru karte hain. Today we are going to understand the stock market completely from the ground up. So what do those flashing numbers actually mean? Honestly, most people watching have absolutely no idea what it is, or more importantly, how it could completely change their financial future. Think of me as your financial mentor today. We're going to demystify all this heavy jargon together. Samajh lo, it's really just like chatting over a cup of chai. Here is our roadmap for today's explainer. We're breaking this down into 4 logical steps. What is a stock? Inside the stock market, how investors make money, and finally, the golden rule of diversification. Let's dive in. All right, Chapter 1. What is a stock? The core of ownership. Okay, before we even talk about buying shares, we need to understand exactly why companies sell them in the first place. You see, when a business wants to grow, like to build new factories or hire more people, they can either take a massive, heavy bank loan or they can invite the public to become part owners. Let's use a simple chai tapri analogy. Imagine you and 4 friends want to open a tea stall together. The total setup cost is 1 lakh rupees. Each of you puts in 20,000. Boom! You each own a 20% slice of the entire business. If the stall makes a 10,000 rupee profit, you get a direct cut of 2,000 rupees. Just like that, you are a shareholder. Now, scaling that up, massive corporations like Tata or Infosys, well, they function exactly like that local tea stall. The only real difference, instead of 5 friends, there could be 50 lakh investors. Buying a stock literally means you own a real legal piece of that exact company. Your small slice grows as the business itself grows. So how does this whole process actually start? It starts with an IPO, or initial public offering. Basically, this is the very first time a company sells its shares to the public to raise capital for growth. After the IPO happens, those shares can be freely bought and sold between you and me. And if you add up the total value of all these shares combined, that's what we call market capitalization. It's essentially the company inviting you to join their growth journey. Moving on to Chapter 2, Inside the Stock Market, a regulated marketplace. A lot of beginners think the market is this wild, scary casino. But honestly, it's actually a highly organized marketplace where these ownership stakes are traded. Think of a massive sabzi mandi, a wholesale vegetable market right in your city. Buyers and sellers come together, and the collective supply and demand determine the daily prices. If everyone wants tomatoes and there's a huge shortage, well, prices go up. If there are way too many tomatoes, prices fall. The stock market is just a digital mandi. The shares are the vegetables, and the prices move purely based on buyer and seller agreement. Now, India has 2 massive digital mandis. On one side, we have the BSE, the Bombay Stock Exchange, on Dalal Street. Founded way back in 1875, it is actually Asia's oldest exchange with over 5,000 companies listed. On the other side, the NSE, the National Stock Exchange. Founded in 1992, it's famous for handling massive electronic trading volume. And regulating both of them is SEBI. SEBI is like the strict, neutral referee of this entire game, ensuring total transparency and, most importantly, protecting investors from fraud. But here's the thing. How do we know if the overall mandi is doing well? Well, we use indexes. The Sensex tracks the top 30 companies on the BSE. The Nifty 50 tracks the top 50 on the NSE. Think of these as a mandi index, a sort of scoreboard that takes the daily temperature of the Indian economy. If the economy is healthy, these numbers go up. So when you hear on the news that the market went up 500 points, this is exactly what they mean. Let's jump into Chapter 3. How investors make money. The reward. All right, this is the part we all love, figuring out exactly how your paisa actually multiplies in the market. There are 2 primary methods, and they're easily understood if we use real estate as an example. First is capital appreciation. That's like buying a flat for 40 lakhs, and then 5 years later, a metro station opens right next door, making it worth 75 lakhs. The asset itself just became more valuable. With stocks, you buy a share at 100, and it grows to 180. Simple. But what about dividends? Well, that's like renting out that very same flat for $15,000 a month. Dividends are regular cash payouts directly from a company's profits, deposited straight into your bank account without you ever having to sell a single share. And here's a really cool fact. The Indian tax system practically guides you to be smart about this.
Just notice the difference in tax benefits here. Short-term capital gains, that is, if you sell under 12 months, taxes your profits at 15%. But long-term capital gains, which means holding for over 12 months, drops that tax down to 10% on profits above 1 lakh. The entire system is explicitly designed to reward patient, long-term investors, definitely not short-term speculators.
Which brings us to Chapter 4, the Golden Rule, Defense and Diversification. You know, knowing how to make money literally means nothing if you don't know how to protect it. Every single investment carries risk. A stock is not a fixed deposit with guaranteed returns. But remember, risk isn't something to fear, it's something to manage. Your absolutely crucial defense is diversification. Imagine your portfolio is the Indian cricket team. A great team doesn't depend on just one star batsman, right? If your opener has a bad day, you still have the middle order and the bowlers to step up and win the match. The exact same goes for your money. You spread it out across banking, IT, pharma, FMCG, and infrastructure. If one sector has a bad innings, the rest of your diverse lineup can still easily win you the financial match. Now, let's move to a very sobering reality check. 9 out of 10, according to a recent CBI study, 90% of individual retail futures and options traders incur net losses. 9 out of 10. The quick money trap of intraday trading and following random WhatsApp stock tips is incredibly dangerous. I cannot stress this enough. The stock market is a wealth-building tool, not a casino. If you treat it like a casino, you will lose, for sure. So what is the best, smartest, defensive move for beginners? SIP via mutual funds. A systematic investment plan lets you invest as little as 500 rupees a month into a diversified basket of stocks, all managed by professional fund managers and strictly regulated by SEBI. It is the absolute smartest, simplest bridge for beginners to get safe market exposure without the stress of having to pick individual stocks. Honestly, bilkul simple hai. And this history proves why patience wins every single time. Over the last 25 years, we had the 2000 dot-com bust, the brutal 2008 global financial crisis, the massive 2020 COVID dip, and yet look at 2025, a total recovery to all-time highs. Yes, the market is volatile in the short term, but historically, it's incredibly rewarding in the long term. Time in the market always beats timing the market. It plays out perfectly, sangeet ki tarah. Which leaves us with one final, very important question. Are you trying to time the market? Or are you actually giving your money time to grow? The Indian stock market has created incredible generational wealth for patient, informed investors. So stay diversified, think in decades, not days, and let aapko Paisa work for you. I really hope this explainer helped clear the fog and got you ready to start your own investing journey. See you next time.